Welcome to Joe's Happy Hour, a show about markets and life hosted by Joe Fahmy. This podcast is for informational and entertainment purposes only and should not be regarded as personalized investment advice or relied upon for any investment decisions. Joe Fahmy is an employee of Zor Capital, and he and his clients may maintain positions in the securities discussed in this podcast. All opinions expressed by Joe are solely his own and do not reflect the opinions of Zor Capital. The views expressed by guests are their own, and their appearance on this program does not imply an endorsement of them or any entity they represent. Thank you and enjoy the show.
Brian Shannon.
Joe Fahmy.
Welcome.
Welcome. Thanks for having me here.
Thanks for being here. Appreciate you joining me. Trader, author, founder of alphatrends.net. You've written 2 books.
I have.
Pretty impressive. I don't think I've read a book in a while. You've written 2. Technical Analysis Using Multiple Time Frames was 2008.
Correct.
That came out. And then this is your more recent book.
Yeah,
Is that
2 years.
2 years. 2023.
January 23.
Technical maximum trading gains using anchored VWAP, volume weighted average price. So super cool. I have an autographed copy. So
you do.
I feel
All
very,
my friends
I
do.
feel very special. So
3 of you.
before I get into the book, give the audience a quick, I mean, most people should know you, and if they don't, they should, but give them a quick intro. Tell them a little bit about yourself.
Yeah, so I've been fascinated with the market since I was about 12, 13 years old and moved into it full-time right out of college, 1991. Broker at Dane Bosworth, Lehman Brothers, a couple places like that, and realized I didn't want to be a telemarketing guy, which is, what a broker is, right?
Yeah.
Harassing people to buy this stock and trust me. Anyway, so, I got into trading with in the back of Investors Business Daily years ago, probably 93. They used to have this thing in the back, 25-to-1 leverage. So you put up 25 grand and they'll give you, I think it was actually 20-to-1 buying power. A company called Generic Trading in New York. The internet was just kind of coming in. I had my 24K modem, and then I upgraded to 48K. It was like lightning fast. So I would trade with Spear Leads Kellogg and Generic Trading, and so that was all I did So I couldn't lose, basically. So that really helped me realize risk management. And fortunately, as a broker, I like to kind of kid around sometimes and say I got to practice with other people's money for a number of years, which, I saw what can happen. And I did damage to people, not intentionally, but, even just buying brokerage, picks and that sort of thing. So I learned how important risk management is. And it's, people talk about risk management, but how many of them are actually like methodical about it and have strategies? So that's what allowed me to succeed in that. I wasn't knocking the lights out. I was making a living. I had a young family, a little baby at home and that sort of thing. I had to borrow money from a credit card to get the deposit. A quick story about that. I was trading the stock Chantel Pharmaceuticals, which isn't a pharmaceutical at all. It was this company that had a miracle cream for wrinkles.
Okay.
And I was trading it really well, and I was planning on quitting in 6 months. But this stock, I was just jamming day after day.
What year ballpark?
That was 93.
93. Okay.
Yeah. Anyways, one weekend I took the day off on a Monday. I was skiing, and I called the brokerage assistant. I said, "Hey, give me a quote on CHTL." She's like, "It's whatever." I was like, "No, that's not right. It's like it's 19, not 12." She goes, "No, it's down 7." Barron's did a hit piece on it, and I had 2,000 shares over the weekend. So I lost 14,000 of my grub stake money. I was like, I already put in my notice. What do I do, right? So got out the credit cards, got cash advances, scrounged up money, emptied all my savings. So not the way you're supposed to do it, but I had to succeed. So risk management was super important. So anyways, fast forward, I opened a day trading office in Denver for them. Broke away from them, formed another day trading office called, what was it called? It was called Landmark Securities.
Okay.
And then merged with David Nasser's company called MarketWise. He wrote a book about it, New York Times bestseller, Day Trading with So's or something like that.
Yeah.
So he kind of got me interested in writing a book. I write pieces of other books. Anyways, that kind of shut down, and probably 12 years ago. I was just trading and putting out YouTube videos. Howard Linsden approached me and said, "Hey, do you want to, turn a subscription service on?" I'm like, "Yeah, I've been thinking about doing that, but it was so intimidating. The infrastructure to just turn it on didn't exist the way it does today.
Yeah.
It was like no barrier to entry. So that began my, professional, advisory, I guess you call it, education product. And that's what I've been doing. So
Your product started with the StockTwits network. That was like
it did. Yeah.
So for some reason I thought you had it beforehand, but it was Howard, because Howard convinced me to just start my blog and just write about stuff. So it was probably around the same time, and you decided to do your subscription service around that time.
Yeah, and so I started on YouTube before it was actually YouTube. I upload them to Google, then Google took them over. So if you go back, I've been on YouTube for close to 20 years, as old as YouTube is. And I was just, building my audience there, saying, once I get to 100 people, maybe I'll do a subscription service. And I was like, because that seemed like a whole lot of people.
Yeah.
Then it was 500. Then it was 5,000. And I'm like, what am I going to do? I don't know how to create a website. I don't want to learn how. And I don't even know the right people. Howard contacted me. He's like, we'll do all the behind the scenes. You get paid this percentage. I'm like, done. So it kind of, started that part from there. So the first book was 2008, as you mentioned. Wrote another book, and just building a consistent business, trying to be honest about this business. As we know, there's a lot of people out there that aren't.
Yeah.
And there you have it. Here we
No,
go
that's
today.
awesome. It's funny. It's the same thing where I didn't do YouTube. I was just emailing friends I called it market notes.
Yeah.
Like a paragraph or two. Hey, this is what I'm seeing, some sectors, just with like 10 or 15 friends I was trading with.
Yeah.
And then a friend introduced me to Howard, and he was like, "You've been blogging this whole time." I'm like, what do you mean? Like, I just heard the word. And again, this is a long time ago. I just heard the word blog. He's like, and same thing. I didn't want to build a website, didn't know how to do it. And he's like, we'll do this, and instead of putting this on an email and sending it to your 10 or 20 friends, just put it up on a blog. So it's a similar concept where sometimes you have the content and the ideas. It's just a matter of having some guidance or someone to help you put it together in an organized fashion. So that's pretty cool.
Definitely.
What inspired you to do the second book? Because you did take about 15 years off.
Yeah.
Not that you're like a regular author, but
No.
But what inspired the second book?
Yeah, in fact, I'm not a natural writer at all. It's really painful for me to write, which is why I do so much video content. But, with video, you can get many more points across and really illustrate stuff versus, static words.
Yeah, you can point it out on a chart and explain the nuances of a chart. You can't do that in writing. It's harder.
Yeah, and in our business, it works well. It lends itself well to that medium. So what inspired me to write that book was, there was just nothing out there about the anchored volume weighted average price. And I kind of, enough time had gone between the prior book, and I forgot how painful it is, that I decided, well, I'm going to do it. And I was actually in New York for a CMT event, Chartered Market Technicians.
Yeah.
And met Jay Woods for the first time. It was probably 7 years ago.
Okay.
And I was really curious. I said, Jay, I've been working with the VWAP. I just got TC2000 to put it onto their charts. Do you ever look at the 2-day VWAP? He's like, who is this guy? Who's talking about VWAP? We talk about that on the floor. Like, how do you know this? So I said, we had a good conversation, struck a friendship and all that. And I decided, through talking with him, actually, it kind of cemented in my mind that I need to write this book. He's like, I've never seen people use it this way. I'm like, I got so many different ways. And, I thought I had the book in my head, but it took me 4.5 years to write it.
Wow.
And it's not like I was sitting down every day trying to write the book.
Of course.
So, I got an initial burst of energy and wrote what I thought were maybe a couple good chapters. Then I got sick and tired of it. Didn't pick it up for 6 months.
Put it down for a bit, come back.
Yeah, and that process just kept going over and over again. And then, and the good news is, though, that it really gave me a lot of time to really kind of refine some of my thoughts and strategies that are in the book, that I got to time test them and say, I do believe this stuff. I'm not just writing a book. This is real stuff that works in the markets if you use it correctly. So I just kind of suckered myself into doing it somehow, because like I said, I forgot how painful it is. For every time you read a sentence in there, that sentence has probably been written 10 times. I mean,
I believe it.
It's not that I'm a bad writer, but you
want it to be perfect.
Your thoughts evolve, and
keep coming back, revising it, editing, and
edit, and you read the same thing over and over again. You read it 10 times, thinking, okay, it's ready to go, and then you read, they spelled my name wrong on the cover, right? It's just stupid shit like that. It's just so infuriating.
Yeah. So you finally write it, and you self-published the book.
I did.
Okay. And you self-published the first one.
Correct.
Talk to me a little bit about that. And it's not a humble brag. I've had some publishers approach me to write a book, and I just have zero interest in doing it for exactly what you described. It's not being lazy. It's just, besides having other things going on, and I know it'll take me forever to do it. Because it's not that I'm a perfectionist. It's just, it's out there forever. I'd want it to be as perfect as possible.
Yeah.
And I also say everything that in my view has been, that I would write about, it's because it's already been written already. Yes, I'd be aggregating anyways. So I've had some publishers, and I just politely for now have said I'm not interested. But talk to me about that thought process of that whole the process of putting the book together, making the decisions, pros and cons versus using a publisher, self-publishing, and all that.
Great question, because I've actually given this kind of speech to a few of our friends about the pros and cons of going with a traditional broker, self-publishing, or there's actually kind of a new hybrid type approach with a company called Harriman, and they kind of give you a little bit of the the structure. From what I understand, I haven't worked with them, so if I'm saying something wrong, Harriman, it's all meant as a compliment. But they do, provide editing and that sort of thing, and they give you much better payout. So if you use XYZ publisher, who everybody knows, you might get, let's say, 20 grand, 50 grand up front, and it seems like a lot, and that's how they suck you in.
Yeah.
And it's giving birth, with a 4.5-year gestation period where that thing's swirling around, kicking in the stomach and beating you up. So that I was at a fair in Denver, like a Labor Day fair type thing, where they have all these booths around the Capitol, and there was a booth that said, self-publish your book. I was like, okay, cool. This is kind of like the blog. I was like, I didn't know how to do it, but now here I've got this booth.
Yeah.
Let's try it out. So anyways, I had the experience of working on a couple of David Nasser's books, like I said. So I kind of understood a little bit of the process, but really was in over my head. So I just started writing a book, and I hired an editor. She was an editor for the old SFO magazine, Stocks, Futures, and Options.
Okay.
She was great. She provided me a lot of good information. And then, so there's a funny story here. It kind of shows you my personality a little bit. I was just getting ready to sign the contract to print, I think, 5,000 of these books. And so I did all the editing, the writing, and then the formatting and all that stuff. And then it was time to pay for these hardcover books. And they gave me a quote, was maybe $19.85 per copy. I was like, I guess that's what it costs. How do I know? Anyways, I went in to sign the deal. The guy who was sitting across the table, his desk, he goes, I'll be right back. I got to go do something. And I see my file on the desk. So I kind of just got curious, reached over, pulled a piece of paper, and I'm looking at it going, cost to customer $19.85, cost to us, it's like $2.37. And I was like holding that paper trembling, going, no fucking way.
That much margin.
So the guy came back in the office, And I was like shaking. I didn't know what to do, but I couldn't.
Because you
let
reached
that
over
happen.
and touched the file that said "Do not touch confidential." Pretty much.
Something to do with my personality, right?
Okay.
Ask for forgiveness, not permission.
Exactly.
So I said, listen, Joe, you made a big mistake. He said, what do you mean? I said, well, you left the office and you left my file right there on the table. I got curious, and I see that you're paying $2.37 for these, and you're charging me $19. That is egregious, and I'm not going to sign this contract unless we can renegotiate it. So I got them down to like $9 or so, which was, it's a huge amount.
It's a big difference.
$10 a copy on 5,000 copies. That's
Yeah.
$50,000 upfront money for. I didn't know if the demand was there for 5,000 of these books. So that's something you have to consider is, the cost of printing. Where do you print it? I've got a printer up in Canada. If anyone wants to know, I can hook them up with that. I mean that legitimately, working with editors and that sort of thing. Then do I want to take inventory? So I took inventory. So I got a truck with 8 pallets, like 12,000 pounds of books delivered to my house. And then this was prior to Amazon. So I just send them out one at a time, media mail.
With the first book you did.
Yeah.
Okay.
And so now it's a lot different. I can just send in, 500 books to Amazon a month if there's the demand for it. And I don't have to think about it. They take their cut, which is well worth it. So, self-publishing, you've got to think about those things. Do you do an ebook? Well, if you do an ebook, if you price it at $9.99 or lower, you'll get 70% of the revenues. Amazon will get 30%. If your book is $10 to whatever on an ebook, they get 70%, you get 30%. So if you make your book $30, you're going to make $10 a copy. If you make your book $10,
You get
you're going to
seven.
make $7.
Okay.
So we're that's just a.
Is that Amazon's
That's
pricing?
Amazon's, yeah.
Okay. So if you ebook and you price it over $10, they take a
70.
much larger percentage. Any
Yeah.
reason for that?
They're greedy. I don't like
Like if
them.
it's $11, they're going to take 70%.
I don't know that there's a reason, but I just know that that doesn't work. I did 100% of the work. Yes, you've got distribution and that sort of thing. So that's a consideration. If you're going to price an ebook, which it's fine if you want a $10 ebook, and you don't have to deal with inventory, you don't have to deal with anything. You just upload it, and it's there the next day, pretty much. So that's a good deal.
Can you? You could probably do that on a website. I mean, I'm sure we can do anything, but you could just upload it and charge on a personal website. Like, remember, there's a comedian who didn't want to do the Netflix or HBO special, so I think it was Louis C.K., and he used to upload it on his site and say, like, I'm going to cut out all the costs and just pay $5 for it or $10 for it. And
Yeah.
it like cuts out all the costs, and he just gets it all pretty much.
I think that isn't that the Taylor Swift model too. Isn't she do all that stuff?
So.
Right?
Yeah, she. Okay, so. But if you do the ebook, it's just easier through Amazon because it makes more sense. Cause
uploaded, it's gone.
Distribution.
You don't have to think about it. Right?
Okay.
And it's available in hundreds of countries, 80 countries, whatever.
Oh, yeah.
So I've actually worked around that. I upload it to Barnes & Noble, upload it to Apple Books, and there's a third one. I forget who they are. But then I get 70%. So it's just Amazon, for whatever, is greedy. So
Okay.
I'm not going to work with them on that department. Physical
right.
copies, fine. So there's all kinds of considerations to do like that. But it's a lot of work. Books are a lot of work.
Yeah, that's kind of the reason I don't want to do it. It's not a laziness. I said, look,
No, I
anything
know.
I'm going to say has been said already.
Yeah.
And, I would consider it possibly down the road if I had more time. But I think it's more of just because I know when I hear 4.5 years, I believe it. Off and on, I totally believe that. Because I know other people have written books and they've said 2 years, 3 years, 4 years. I've heard that. Because you're constantly coming back and revising it, and you know it's out there forever. So it's pretty fascinating. Thanks for sharing that. So you tell us a little bit about alphatrends.net. What do you offer there as far as this? It's a subscription where market analysis and so forth. Obviously, I'll let you explain it.
Yeah, no. I mean, that's it. It's not very complicated. In fact, one of my favorite quotes, and the quote is in the book, is Michelangelo's simplicity is the ultimate sophistication. And I've heard it in the market that the market's greatest disguise is simplicity. So I try to keep things as simple as possible. Price action, only price pays, as you know. I
Yeah.
say. But I provide an educational product that is stock-based, where we talk about, NVIDIA has pulled back to this place. It looks like it's getting ready to bounce again. The pullback seems to be over. We want to buy it at this price, set our stop here. Here's where it looks like it has a reasonable expectation to go for swing traders. So the time frame for me is generally anywhere from a couple days to maybe 3.5 weeks. And it's all dependent upon price action. I don't decide, hey, I'm going to hold it for a week, right? That's just random. Just like risk management is not random. It's below the most recent relevant high or low definition of trend for where my stop will go. So I try to be as methodical about it as possible. Price, volume, and time, which of course is the components of the anchored VWAP. So I teach this to people so that, a lot of people look at a service and they kind of don't know what to expect. I think they think, well, this guy's smart. He trades. He's just going to give me stock picks, tell me buy here, sell there, and I'm done. I don't have to think for myself. And, we've discussed this, Joe, that's not the way it works in real life. Everyone has to find their own way in the market. We all have different time frames, risk tolerances, whatever it may be. So I try to explain, this is for a swing trade. If you're looking at an investment, it looks like their fundamentals are pretty good. You should go dig into that if you're looking at this as an investment, because the chart looks like it could support that. If you're a day trader, maybe set your stop a little bit tighter here, or give it a little bit of room, a little bit of time to settle down before we get involved. So it's fresh content each day with, stocks that are set up in a low risk, high probability way.
Okay.
Focus on risk management, not price targets and that sort of. My price target for a long is always higher. Let's let the market tell us. And for a short, my price target is lower. I don't really like to short too much. But that's it in a nutshell. Is that provides, so I have a Discord for people to get feedback on stocks they're interested in. Do a couple webinars each month, so it's interactive, and everyone. I try to make it so that people can say, I learned something. Even when they cancel their membership, the best cancellations are, you've taught me. I need to go, spread my wings, try this myself. Thank you for the great foundation. That's a success.
Of course.
Yeah,
of course.
I love that.
One of your famous expressions is only price pays, and another one I love is make the ideas your own. Because, and I know we've discussed this, I feel like a lot of people just want to be handheld through a trade. They want to be told, buy here, this is where you stop, sell here. And the frustrating thing for me is I don't think people realize, I always say, not everyone trades like you. Because the person hearing this is like, no, I want to be told to buy at 50, stop at 48, and whatever, sell at 55. But how do you tell that to someone that works full time, that might not be able to watch the market? What if it's Warren Buffett? He might not, tell him to buy at 50 and stop at 48. He might be buying it down to 20 all the way because he has a different time frame. Right. And there's no right or wrong, and that's why I love your expression. If you maybe explain that a little bit, make the ideas your own.
Well, I think it's just like you said. I mean, if you really want me to just tell you buy here, sell there, why don't you just, like you have your product where you manage money. You're a money manager.
Yeah.
You're like, why would you sign up for the education product and expect me to say buy here, sell there, and you're just clicking the buttons? You might mess those up. You might hesitate at that point where you think, as the professional money manager, you should be involved, and you don't have those hang-ups. You don't have the second doubts. You look at it and say, I've got my decision. It's made. I like this company. I'm getting involved here. And so the make it your own. Some people just want to be day traders, and they'll come into Alpha Trends. They'll say, "What do you think about this for a day trade?" I'm like, "Good luck." I don't do day trades. I said the concepts are all the same. Here's how you might want to look at it. And I try so hard not to get sucked into the day trade conversation because they will just get you in quickly, and then you can't get out of it. So it's, I'm not an investor. I have some investments, but my specialty is swing trading. That's where I've spent the majority of my career, and hyper focus on risk management.
Really quick. So swing trading, I know there's day trading, long-term holds,
Yeah.
and swing trading is still a broad range. Some people think of swing trading a couple days, couple weeks, couple months, couple quarters. So that's still,
Right.
I mean, and there is no right or wrong answer. How do you look or define swing trading with your time frame?
You're right. There's and some people call beyond. So you have day trade, swing trade, and then people say position right,
trading.
like
Yeah,
maybe 6 to 12 months. I think is considered position. And
yeah.
if you get a capital gains rate of 15%, then you're definitely an investment, right?
Right. Yeah.
So what's that? 18 months?
12 months.
Is it?
Year for long-term capital gains. Yeah.
Okay.
Yeah.
It used to be 18.
No,
See, this isn't a problem I have to deal with.
No, it's if you hold for a year, it's long-term capital gain
Okay.
or loss, depending on
Check with your financial advisor.
exactly. Check with your tax professional. But yeah, it's 12 months. Yeah.
I lost my train of thought. There.
What's your time frame when you say swing trade? Just so the audience knows, what's ballpark your time frame?
For me, it's got to survive as a day trade. I don't intend to day trade a stock. Generally, unless I'm bored and just feeling like a junkie sitting there,
Yeah.
and see an opportunity and see a $5 bill, you're going to pick it up, even though you're going for hundreds, right?
Yeah.
Or thousands. And so for me, if it survives as a day trade, I don't get stopped out. Well, then now we have the ability for this to become a swing trade.
Okay.
And I'll generally take a third off really quickly. I like to go in with pretty heavy size relative to what's responsible. Or what people
Okay. Most people start small and scale in. You're just like I'm going balls deep pretty much in the position.
The general my average hold time is probably 3.5 to 4 days, somewhere in there. Maybe even 3 to 4 or 5 days, somewhere in there. And I don't look to hold for a certain period of time for a swing trade. I've held some swing trades last year for 3.5, 4 weeks. As long as I get into the stock, I'll take that first third off. And the reason I get in balls deep right away on my A-list positions is that I'm looking at that stock. I'm aware of the weekly time frame, and I see it's coming into this stage 2 uptrend out of a long-term base. The fundamentals are starting to shape up. And then, I've got the daily time frame. It's just pulled back to the 5-day moving average, the 20-day moving average after a nice volume surge. Then I look at the 30-minute time frame, and I look at the 15-minute time frame, and I'll look at a 5-minute. And on the day I make the trade, I'll enter on a 1-minute chart.
Okay.
So I want
ideally everything's lining up.
Ultimate precision, like sniper entries.
Okay.
So I'm at that point where if I'm going to get this, I'm maybe even helping the stock move by my aggressive buying. And, if it's a stock that trades 500,000 shares a day and it's a $7 stock, I don't mind gunning the offer and pushing up a little bit through with some size to get other people to be the trigger. You see a clear level that if it breaks above this, it's likely going. So I want to be the guy pushing that sometimes. Okay. And I don't do that as much as I used to, but that's a lot of fun too. And so, the stock jumps up to daily R2, which is, a technical tool, floor trader pivots, if anyone wants to look it up. And it'll get up to there. I'll sell a little bit that day, maybe even a third, because I've got, like I said, irresponsibly large size relative to what I should be doing. So I want to immediately reduce some risk and be in a position of strength. So if I bought the stock at $10.50 and I took a third off at $11.10, I've effectively lowered my cost basis to $10.30. Now my stop that was at $10.10 is only 20 cents away instead of 40 cents away. So that's the way I'm looking at it. And then as the stock goes, so I had a stock just this week, SFH, I think that's it. I don't even know. Silver Lake Financial. I think I bought it at 58 and change. It just broke out today to a 52-week high. The prior high was made about 8 days ago. So it just ran 11% and broke out. Okay. So I sold a third there. Okay. Because, you hear people all the time saying breakouts don't work. Well, where did the breakout occur? Did it occur from a nice tight base, or did it run 10% in 3 days and then break out? Because if you're buying the breakout after a 10% move, you're late. Yes. And I will happily give you some there. So then I'll hold that final third, and I'll give that third a much wider stop. So, than I might normally. So I want to look at this thing and say, okay, the first day I got a third off with, 2%. Then I got another third off with 6%. So I'm up 4%. My risk is above break even at this point because it's pulled back and made a higher low. And then I'll just kind of use the definition of trend loosely. And what I like to see is higher lows above a rising 5-day moving average. So if you look at Facebook, 17-day tear.
Yeah.
It held the rising 5-day moving average until 2 days ago. It broke that 5-day moving average and made a lower low. And I think it's dropped 7% or something like that. So that's how I'm looking. So, in the case of Meta, it was 17 days of runs. Unfortunately, I can't say I owned it, though. Yeah. I'm just using that as an example.
Sure. As it's running, so let's say maybe at 2%, 6%, 10%, you're taking a piece off or whatever. Are you setting your stop at break even, the old adage, don't let a winner turn into a loser, or are you moving your stop up so that even when you're out of the whole trade, you still make money? Or does it depend?
Yeah, it depends, really. I mean, if the stock just runs up real quick and I don't have a more recent higher low that's important, I want to give it a little bit of room to say, okay, I got that first third off on the initial spike. Now it needs to settle down a little bit, either keep going or settle down, maybe correct sideways through time for a day. And then if it breaks from there, then I'll set my stop underneath that day's low. And that initial stop I make a little bit tighter. Then once it starts getting a little bit of legs under it, then I'll widen it out a little bit and try to see if I can hold, for instance, that final third. I've been in this trade. The first day I took a third off. Then I think it's been about 4 days. And I'd love to, sell that final third in 3 weeks up $20. And I never care that I sold that first third early because that first third serves a purpose. It's risk reduction.
Yeah. And it reduces the position size to give you a little bit of comfort, room, whatever, clarity.
Be in a position of strength.
Yeah.
Right? I mean, because, we all have that. Whenever I press the buy button, I have a little bit of, I could be wrong here. This would suck. That stops way down there. This better get
sign
going.
Of a great trader.
We have.
You have to have that.
Yeah, we all have that hesitation. It's like you do a presentation. You have butterflies. Well, it's not that you're nervous. It's that you're taking it seriously and you care. So you want to do your best. You want to make sure you're on your A game, and your body's telling you, step it up. Get ready. Here, And then once the stock starts moving, then you can breathe a little bit. And then people say, well, winners take care of themselves, which isn't true. You still have to manage them. It's a lot easier to be in a winner, but you still have to raise your stop up under the higher low that makes most sense for whatever your time frame is. For me in swing trades, it's generally the most recent higher low above a rising 5-day moving average.
Okay. So in whatever 10, 15 years you've been working with people, whether it's, I'm sure mostly retail, some institution, all sorts of stuff. What are the 2 or 3 most common mistakes, lessons that if you could summarize, like say, hey, these are the things that everyone should work on? Like common themes you've noticed just from working with so many people.
Well, of course, FOMO and, the fear of missing out and what that
I thought it was fear of missing Oprah. Isn't that what FOMO stands for?
I think you could get a better O than that, Joe.
It's the only O I can think of. Fear of missing out. Sorry. Anyway.
The big O. Fear of missing. Yeah. Okay.
Anyway.
So that was going nowhere productive.
Exactly.
So the way that represents itself from a lot of people to me is they'll ask about a stock and they'll say, hey, Brian, what do you think about XYZ? I'll look at the chart, and for some reason, it's just really strange. Like the majority of these stocks that people ask me about are up 10% in the last 3 days. It's the most bizarre thing that it just it's 10% in 3 days. Then people really get interested in it. So
I've noticed that too. You give a stock at 50, that's your entry point, and it goes to 55. Can I buy it now? Same thing?
No. It's a different risk reward. It's a completely different trade. It doesn't exist anymore. That's not what we're looking at. So I always encourage people to say a couple things. What's realistic in the market? 10% in 3 days, that's a good return. You're gonna tempt a lot of people to take a profit, if they're traders. Do you think you're early to this? Do you think you have special knowledge? Or do you think you're a little bit late? Where has it come from? Right? So how much energy has it expended? And it doesn't mean it can't go 12, 15, 20, 30%. But what's reasonable, for that stock? What's the ATR of that stock, ATR percent? If the average percentage range of that stock is 2% and it just went 10% in 3 days, well, math says you're extended. You're not early here. It's been straight up. So where has it come from and where does it have the potential to go? And if it went to that 55, let's say it was 55 a week ago, it pulled back 2 weeks ago, it pulled back, it runs, we buy it at 50 because it based at 48 to 50. We buy it at 50.01. It runs to 55. Like I said, I'm taking a third off. That's when people say, hey, it's breaking out. And, well, it's up 10%. A breakout up 10% isn't a good breakout to chase. Doesn't mean it can't keep going higher, but where's your stop now? Because my stop is at 53.26, that low from 2 days ago, something like 2 pennies below that. So it all depends on your time frame, but that is absolutely one of the most common things.
That's the first one that came to your mind. Interesting, was FOMO.
Well, and it's because I deal with it almost every day.
All the time.
Constantly. So it's come to the point I say, did you go through the questions? Where has it come from? Where does it have the potential to go? Well, it can go higher, sure. But where has it been previously? Is there a prior level of support where people have been trapped there, might be tempted to get out, release enough supply that overwhelms demand, and the potential for resistance? I hear that's something all the time. Hey, that stock has resistance at 55. Because it got rejected there once, that's not resistance. That's a level of interest to say, okay, it ran up quickly. Let's tighten our stop. Let's be aware. There might be some profit taking. I have a 2/3 position. I want to be tight with half of my stop and let the rest run, but I don't want to let this big gain, 10% in 3 days, go against me and sell it up 1.8% when I had 10. I want to be protective, protecting profits. And complacency, that would kind of dovetail into the second part, second answer, is that people become complacent. They don't, we go through a good period of time. November and December, we had all those theme stocks, robotics, quantum, drones, all just going, 200-300% in a week. And people thought that would just continue to happen rather than viewing it as a sign of froth that we need to slow down and digest these things. So people become complacent and think, well, last time it pulled back, I sold it, so it's pulling back. I'm going to, instead of selling it at the 10-day moving average like I normally would, I'm going to give it room to the 20. It broke the 20. I wasn't paying attention, didn't have my stop set. I'll set my stop. I'll give it down to the 50. And now they're down 8% in the stock because the 50-day moving average. So it's just, and then just getting yourself into the position where, like, now what do I do? You got to puke the position out or just, ignore it?
So in both of the answers, avoid FOMO and complacency, I think both of those have to do with recency bias, where a stock is going up in the case of FOMO, and that's all they see because they just recently saw this. In the example, the stock goes from 50 to 55. That's all they've seen.
Right.
So, hey, my sports team just won last night. They're the greatest team ever just because of one game.
Right.
Recency bias, we're affected by that. And then complacency is the same thing, because if it is a couple month nice, strong uptrend in the markets, you can see a stock go from 50 to 80 with barely pulling back.
Mm-hmm.
So you get used to that. You get used to that recent. You forget, stock's actually correct. They actually build bases. They build different stages. They do all sorts. Like, people forget these things. And it's interesting because those both lead to the, two of the common mistakes that you're talking about.
Yeah, so it's not about what stock it is. It's about human emotion and, our biases, as you said, and trying to be objective about it and say what's reasonable. And, that kind of leads to another thing is, what's the personality of the stock? You've got a $3 robotics stock, or you've got NVIDIA, which can have crazy moves. We just saw that recently. But they're going to trade different, from a small biotech. Small biotech, you look at these little biotechs and people get all excited about them. And on the daily chart, it looks like it's breaking higher in big volume. Then you back it up to a weekly chart and you see it did the same thing 8 times in the last 3 years, where it spiked up 200% in 1 week and then just dribbled down for the next 6 months. So understand the personality of the stock. Don't buy biotech stocks when they get hit. There's something wrong with the science. Generally, it's going to take a long time for them to recover versus an NVIDIA, where it's, DeepSeek, someone that has this chip, and it sent a shock to the market, but it got gobbled up. It got, it recovered nicely. So an institutional stock versus a little, play toy thing that, all the penny brokers and people, penny traders rather, the short sale guys are all over, and we know that crowd. And some of them do great with that. I'm not disparaging that approach. And that kind of leads me is, I identify as a swing trader. That's my specialty.
Yeah.
People say, well, what about your investments, Brian? Like, don't worry about my investments. I don't consider myself an expert investor, so I'm not going to give you advice on that. You're here to learn about swing trading. That's where my knowledge base is better than 99% of the population. And my risk management principles that I'm going to teach you are going to help you stay in this game. So, all psychology problems, Joe.
Yeah, that's what 80% of everything in trading, especially psychology. We are here with Brian Shannon, a great friend, amazing trader. This is his most recent book. What I found really interesting, Ken Griffin from Citadel refers to VWAP. He refers to it as, he's Citadel's, one of the largest market makers, and, he's a big money manager and so forth. He discussed it in his testimony to Congress, and that's very fascinating. You want to talk a little bit about that? Story fascinates me.
It is. So, we see statistics all the time. 50% of the market volume is institution, and some people even say, 30% is dark volume, dark exchanges. Does it exist? Like, how do you account for that in your VWAP? And those are great questions. But, Ken Griffin, when they were talking about GameStop, they, the senators paraded their suspects in so they could grill them and look cool in front of the constituents. Yeah, and anyway, so it's the whole theater of it. And then I didn't really, I had it on in the background, and I didn't really expect anything of substance to come out of it, anything useful to me. Like most things on financial television, they're not useful to me. It's just, information. It's not price information. But Ken Griffin said, when we do, we do 35% of all retail volume, all listed volume rather, not just retail, listed volume. And most of our orders are algo driven based on mainly VWAP. He said VWAP for a day, for a week, a month, or other periods. So when he said that, the guy made the year of that, was that
2021 or 2, yeah, 1 or 2, yeah.
Well, the prior year, he made
21, yeah.
His income was $4.1 billion, the highest a hedge fund manager's ever been paid. Now, it's probably not an honest hedge fund number because he has all his other arms of what he does.
Yeah.
So, still a great fund manager, but maybe Tepper's probably made more, but Tepper doesn't control 35% of the volume and, doing algos for retail trades and that sort of thing. But, when the guy who controls more volume through his firm than anyone else says, this is how we handle orders, you got to pay attention, right?
Of course.
So these are view. So when you see a stock that reported earnings and, it gaps up, hangs around for 2-3 days, then it starts its post-earnings announcement drift, as they call it. It'll run for 6 days, and then it'll pull back. And the volume-weighted average price from the earnings report will just act like glue. It'll a magnet. It'll come down to that. It might pause a little bit. 20% of the time they fall through. 80%, I'm making these numbers up, but it's just my anecdotal evidence.
Yeah.
But you'll see, you don't buy the dip to the VWAP, but you watch it very carefully. And as it starts to bounce from that VWAP from the earnings, you want to buy it because what they've shown you is that an institution who wants to buy 2% of this stock, it's been on the radar. The company reported earnings. Now it's breaking out of this long-term base. We want to own 2%. In order to own 2%, we need, the stock has 100 million share float. So they'll say, I want to buy, let's say they want to own 3% for even numbers. They'll say, I want to buy 3% of this stock over the next quarter before their next earnings report. So they're going to buy 3 million shares in the next 3 months, a million shares a month. Now they'll go back and they do what they call time slicing. So time slicing says, so the point of an algorithm is that they don't want to tip their hand to the market and say, put in a bid for 3 million shares and everyone, 120, everyone jumps in at 120.01, then people front their 120.01, then they move their 3 million share bid up, which doesn't exist, right? So they want to put in, that's why in a level 2 you see 200 share bids, 500 maybe.
Yeah, or sometimes even odd numbers, 133, 47. I've seen some institutions say they hide it make it look like they're just, odd lot type of trades.
Yeah, so they'll time slice, they don't want market impact cost. So they don't want to show their hand. Everyone starts front running them. They know there's a big buyer, so they're going to chase it higher. That they want to avoid that. They do that through time slicing and order size. So if the stock trades, let's just say, the average volume, they decide they're going to do 1 million shares a month, January, February, March. They might actually look at it and say 30% of the volume over the first quarter occurs in January, 40% occurs in February, and 30% in March. So they're going to buy 40% of that 3 million, 1.2 million shares in February. So then they look and I say there's 22 days. Divide that by, now we've got to buy, 180,000 shares per day. But Mondays are typically a little bit stronger. So they'll buy 200,000 shares on Monday, 140 on Tuesday. So they look at it that way. Then they break it into time intervals. And this is getting into the nitty-gritty of how this works.
No, of course, yeah.
Hopefully I'm not losing the audience.
No, it's okay.
So on Monday, they're going to do 200,000 shares. The stock was up yesterday, so they might start out the day by shorting 5,000 shares into pre-market. They'll see a bid for, let's say it's 120. They'll see a bid for 100, for 500 shares. They'll put a 5,000 share offer on it, and they'll fill that person for their 500 shares at 120. Then they'll have an offer hanging out for 4,500 shares. That scares other people, so they start hitting bids. So then now you got the stock gapping down maybe $1. And in order
so they created the illusion of a seller to buy lower.
Correct. So
okay.
they by the time the market opens in the pre-market, they might have sold short 12,000 shares, but they got the stock down $1. And the stock trades an average of 2 million shares a day. They've got 200,000 shares to buy. So they cover their short. Maybe they make a little bit of money on that. But then they'll go and they'll say, okay, we've got this stock down $1, and we know we're a buyer for the rest of the day. So let's try to buy 80,000 shares in the first 10 minutes. And when they buy that 80,000 shares, everyone looks at it and goes, wow, we threw our stock away. That was dumb. Let's buy it back. Let's cover my short. It's not going lower. And then they will put it into, time buckets for the rest of the day. Noon to 12:30, it trades 3% of the volume. So they'll buy, let's say they've got 100,000 shares left. They'll buy 3,000 shares in that half-hour period. Last hour of the day, it trades 20%, so they'll buy 20,000 shares. So it goes on like that. So what you notice is when it pulls back to those VWAPs, they're ready to strike, and they might even help create it. It'll get 2 standard deviations above. So Goldman might have the order to buy this over the next 3 months, and they might do a guaranteed VWAP order. So if at the end of 3 months, the volume-weighted average price of the stock was 150, maybe Goldman, through their shenanigans, shorting it lower, actually filled this order at 148.20. All they have to do is give it to their customer at 150, and they make $1.80 per share on this 3 million share order. So they're incented to do that. That's how a market maker gets paid, right? So if they do a guaranteed VWAP, or they can say, best efforts, we'll pay you 6 cents per share, whatever they're paying now. It's super fascinating how
it is.
You break it down, the micro mechanics of the market.
Yeah.
But the bigger point that shouldn't get lost is that's why these levels often do act as magnets, and when they get there, they become support, because those programs are in there showing 47 shares, trying to suck in 150,000 shares if they can.
Okay.
And then as it starts bouncing away from there, you know there's a bidder. You know there's a bidder who has shown his hand. This is what his algo is. And now we can buy with that as our protection level. That's where our stop goes. We've got it. It's bouncing away from there. We didn't have to take all the risk of buying the uncertainty as it gets there and drops 10% to that point. But now it's bouncing. I can set my stop below that pullback low. And now hopefully I can hold this for 3-4 weeks.
Okay. Something, if you can help me understand, I understand VWAP, but anchored VWAP, how do you, people will say, well, this is the VWAP anchored from an earnings date, from the beginning of the year, from the last Fed meeting, from a CPI, whatever. How do you decide what to anchor to?
Yeah, so real quick, the VWAP itself was just for a day. That's what it was created for, to say, is an institution getting a fair price from their broker?
Yeah.
You know, I sent you an order for 250,000 shares of Cisco. It was invented in 1988. So did I get a fair price or not? So that gave them a benchmark. And now the question, how do we know where to anchor? Basically, again, the market's such a big game of chess psychology, right? And just as an aside, you know, fundamentals to me are no different than the technicals, meaning there are reason to be interested in a stock, the fundamentals.
Yeah.
Like we all hear, you know, you should have 20% growth, 20% in revenues and earnings or whatever your basic numbers are. And a lot of people have that benchmark. So when a company reports 50% revenue increase and 128% earnings and they raise their guidance, you know that there's just this huge group of fund managers that are going to support this stock. And it's got a great looking chart. So we start to say, what programs are they turning it on? How do I get inside their heads to make it so I can take as little risk as possible, but still participate in what's going on here? Again, I lost my train of thought, Joe. Long day, sorry.
It's okay. You've given a couple presentations today with where to anchor from.
Oh, right. So anything that really acts as a market catalyst. So an earnings report is great because especially like an earnings surprise and you get a big percent move.
Right, because it's usually like a surprise CPI. It's not just so it's like a catalyst. Yeah,
anything that causes what I call, you know, a rapid reevaluation of prices.
Okay.
So a Federal Reserve announcement. We all know what happens at 2 p.m. on those dreaded days.
Yeah.
Right? The market will rally 1%, then it'll drop 3%, and it'll close up 2% on the day. That was a catalyst that got a lot of people to say, wait a minute, he said therefore 3 times. That means this or whatever.
Oh, there are algos that will comb through the Fed statements and from everything he says in his press conference.
Yeah, Alan Greenspan's briefcase indicated how thick is it, right? So when we look at something that causes that sudden revaluation, that becomes a price memory, an event memory, and a new anchor in people's mind. Since that event, since the Fed cut rates, since the earnings were reported, since the FDA approved this drug, how's price action since then? Because the price consensus changed rapidly. Now we want to say, okay, everyone got excited. Were they overdoing it? You know, so for a couple days, you'll see it, you know, crossing back and forth above and below VWAP. Maybe it's stuck, and then it definitively breaks back above it. That's when you say, okay, the buyers are back in control. We had a little, you know, the stock was up 10% on a gap. We had some natural profit taking. We had the pessimist in there selling it short, thinking that they were picking the top and this is a bad company or whatever it is. So it fades for a couple days. Then all of a sudden, the dip buyers are back in the money. They're now in a position of strength on average. The short sellers are losing money on average. So we know with 100% certainty from that event, the average price is now below where prices are trading. So, and we just crossed above that number, so the buyers have regained control. It doesn't mean they're going to maintain control, but they've regained control. And if they're going to stay in control, I want to be in the stock as long as it doesn't go below that pullback low. And then as the stock starts to move higher and make those pattern of higher highs and higher lows, as it makes a higher low, my stop is no longer below the pullback low, but now I'm in a much better position to protect my profit, hopefully, that I've taken a third off and maybe I'm at break even. I won't put my stop at break even just because break even. That doesn't mean anything to anyone but me, right? So some people say, I'll put, my cost average on Apple is 87, so I put an anchor on that. Well, you're the only one anchored to that. But how many millions of shares traded on the day that earnings were reported when we saw that 8% gap? That's what people are measuring against.
Oh, okay.
So if the buyers have regained control, I want to be involved. If it's pulling back, there's a couple, Confluent. I don't know if you saw that one. They reported earnings last week, CFLT. Big gap up, great numbers, coming out of a large base. It looks like this is a stock that can go 6-9 months. But it's pulling back every day so far. Today was down 3.5%. And I've been just itching to buy this thing. But I don't buy the dip. I want to buy strength after. It's not my job to say it's done going down. It's my job to say it looks like the sellers are done. The buyers are stepping up. It's back above that VWAP. The buyers have control. I want to join the winning team.
On a resumption of strength.
Yeah, I'm a total fair weather fan in the stock market. If the buyers are winning, that's the team I want to be on. And I want to recognize it as soon as the first field goal is on the board, 3-0. That's my winner. If they continue to do well and score and play good defense and make higher lows, I want to be on that team.
Yeah. My Patriots are up 3-0 against the 85 Bears, and they lost 55-10. But I get your analogy.
Well, hopefully you got stopped out at like 10-3 or something.
You presented here at the Money Show. I know you've given a lot of talks. I've heard a lot of your talks. In your mind, is there any presentation, TV appearance, anything you did with a talk or media that was like nervous, proudest moment, like a really big talk, anything like that sticks out?
That's a tough one, really, Joe. It's, there's some of the ones I like. I was on CNBC once, and there was a guest there who decided he was going to break my balls.
Okay.
And that was kind of funny because everyone said you handled him well because I just stuck to the facts. It's like, well, if people don't like Tesla, then they don't have to buy it. And if you don't think it's a buy, I was saying it's a buy with a stop here. He's like, yeah, but Brian, it's way overvalued and all this. And I'm like, well, if it goes down, I got to stop. I don't care.
Yeah.
You seem to care. I don't know what your problem is. So I was proud of the way I handled that because it was my first time. I was really nervous for that one.
Yeah.
But I really like doing the compound, the last one in particular with Josh and Michael. Let's see, the Fox, Charles Payne.
Oh, he's great.
He's great.
He's great.
Super, just really professional, just puts you in a position of strength.
That's awesome. Yeah, no, he's great. That's, I was going to ask you about before we wrap this up.
Yeah.
Two last questions. Trading is, it can be isolating, and there's a lot of the mental part, as you talked about. Because I do believe trading is like sports. It's 80% psychology. How do you handle that? How do you deal with the sometimes loneliness or whatever psychosis of trading?
Yeah, I'm good at that for whatever reason. I don't know if it's a personality flaw or strength.
It's definitely a strength.
In this business, it is.
Yeah.
But I find when I listen to other people's opinions, anyone's opinion, it takes me off my game. I don't watch TV during the day. I might look at, Twitter and say, I respect that person. They're looking at this stock. I don't care why they're looking at it. I want to pull up the symbol. And if I like the chart, and then maybe I'll look at, market surge and see the fundamentals there. Okay, I can see the psychology shaping together here. I see the market structure. And just a real quick thing going back to mistakes people make is, getting the anchored VWAP and just thinking, that's it. I've got to figure it out. You need to understand market structure as a whole first. The Stan Weinstein, Wyckoff stage analysis, and really understanding that, the odds aren't against you. The odds are against you if you're buying a stock in a downtrend. It's lower highs and lower lows. That means the sum of the declines is greater than the sum of the rallies. You have less opportunity to make money. Yeah, you can trade those bounces. So, keeping it again simple. I kind of went off.
No,
there, but
no, that you reminded yourself of another mistake that people
Yeah.
make. So there's nothing wrong with that. What's the best advice you tell yourself 20, 30 years ago?
cut losses. Don't believe what you hear. Look at price action. Don't believe some expert on television. I don't watch television during the day. If I do, it's
Cartoon
boring.
Cartoon
It is
Network.
Cartoon Network, yeah. But I
Little
can't
episode of
because-
Cops during the day.
Yeah.
Keep you excited. Yeah.
Well, I would, I'd find myself out of boredom, getting excited, thinking I can, guess the name of the ticker that they're teasing at the break and get in before they. I go, it's a robotics company. It's $8. Oh, that's this one. Buy that quick, and then as they announce it, I'll try to sell it and play those stupid games. So it just really takes me off my game to listen to other people's opinions. So I have trust in my abilities to listen objectively to the market and say, here's the message of the market. And if the message of the market is confusing, it's going back and forth above and below these moving averages, not finding any support in the places it's supposed to, that message is crystal clear. Leave it alone. It's just leave it alone.
All right.
You don't have to buy.
Any closing thoughts?
Joe, great.
Yep.
Yeah, great.
Pretty cool studio, huh?
It is. I've listened to 95% of all of them. You've got some amazing guests for people who aren't familiar with it.
Thank you.
Joe's really got a professional gig here going. So I know you do it for fun. I hope you can turn it into something bigger one day.
Yeah, no, I appreciate that. I'm enjoying it. I enjoy the conversations. I'm learning a lot too. I've had some guests where I sit back and the first two times I wanted to take notes, and I'm like, wait a minute, I can watch it later and pause it because I can't sit here and take notes while you're talking. So I'm definitely going to be taking notes on this one. Thank you for being a great friend. Thank you for your kindness. Thanks for enlightening the audience with a lot of the insights. So
Right back at you, Joe.
Yeah, and we'll
Keep it up.
everyone please go out and pick this up. You can find it on Amazon.
Yes.
That's where I got a lot of my notes from. So
Awesome.
you can find it on Amazon, and hopefully we can do this again soon.
Love to.
All right. Thanks so much, Brian.
Always
Appreciate
a
it.
pleasure.